It's early in the year, but the affordability push from DC might have big impacts on our market. I'm Tony with Clark & Santoro, and this is our real estate update for the week of Friday, January 16th. We know that buying or selling a home can be very stressful and confusing. That's why we do these weekly videos, so you can know how the market is impacting your options as a home seller or buyer. Starting off, looking at how the market performed this week, there are 18 active homes on the market, which is up from 15 last week, with an average asking price of $1,895,000, a little bit less than the $1,954,000 we had last week. 4 homes went pending this week, whereas we didn't have any last week, and the average pending asking price for pending homes was $1,572,000. 2 homes closed this week, double the number we had last week, and the average closing price increased significantly to $1,792,000, up from the 1 home that closed at $1,582,000 last week. So now that we know how the market performed this past week, we can look at the broader trends that help us understand where the market is going to be heading this year. Before we look at those trends, if you find this information helpful, why don't you hit the subscribe button down below and ring the notification bell. And while you're down there, why don't you hit the share button too and share it with a friend. Everyone deserves to be in the know about their local real estate market. Okay, let's take a look at those broader indicators. For inventory, it's early in the year, so it's expected that inventory would be low. Starting the year below 20 homes on the market is very typical. However, since the market has been soft over the past couple of years, having the inventory start the year already about halfway to our normal level gives me the sense that it could quickly balloon up like we saw last year, where it jumped up to almost double a normal market if we don't have a stronger spring than we did last year. At this point in the year, the turnover rate doesn't really say much about the market. We're still in the time of year where not a lot is going on or will be happening. Homeowners who are planning on selling are just starting the process of getting their house ready, so we won't see a lot of new listings quite yet. And likewise, a lot of buyers haven't jumped into the market really consistently yet either, so it's unlikely that we'll see a lot of pending sales in the coming weeks. The over-under number is still holding from in a holdover from the year end. It did jump up significantly at the end of the year, where it crossed into the positive range for a little bit at the end of December and the first week or so of January. But we're back down to being in the under range again. It is within 1% difference, so it's still relatively neutral and really doesn't add much knowledge for now. The 30-day rolling average is down for sales price to just over 1.8 million. The overall average was down year over year at the end of last year, so starting 2026 with a slightly softer average sales price is not surprising. With recent news about interest rates finally falling and affordability making a little bit of a rebound in general, I would imagine that our average home cost will hold around 1.8 for the time being, with the potential of it spiking in spring depending on other market factors. The Triple Q fund has been holding relatively flat, not fat, for the past few weeks. There was news recently of a new round of layoffs at Meta or Facebook this month. But at the same time, there's a lot of market expectation in AI, which is a large part of the Silicon Valley tech world lately. So those two factors are kind of offsetting each other. Either way, the strength of the tech job market is not putting any real upward or downward pressure on the market at the moment. interest rates continue to just slowly creep lower. They are just below the lowest rates that we've seen since they skyrocketed at the end of the COVID market. While this does improve buyers' affordability a little bit, that rate is still not enough to offset the overall cost. We're still above 6%. So it's not enough to offset the overall cost of everything else, and is nowhere near low enough to incentivize entrenched homeowners to sell off their homes at their sub 3% mortgage rates to make a move up. So a decrease is nice to see, but it isn't enough to really get this market going quite yet. It's too early in the year to make any big statements about where our market is going to be heading for 2026, though I do expect that it will be a slow start to this year. The Trump administration has really started to make moves that they claim will positively affect overall economic affordability as it gears up for the midterm elections. So if those moves do move the needle on inflation, that might help shake some new buyers and sellers loose into the market. However, part of that affordability push is specifically regarding large investment firms and restricting their ability to buy single-family homes. And that could have the effect of putting downward pressure on home values, which would be great for buyers, except that it might just give current homeowners one more reason to not sell. Thanks for joining me for this weekly update. I hope it helps you understand how our market is impacting your options. Don't forget to subscribe and hit the notification bell so you can stay informed on how our market shapes up this year. And if you have any questions about how you can navigate this stressful, confusing process of selling or buying your home, reach out to us directly. We're here to help guide you every step of the way, or you can leave a comment down below. Thanks again for joining me. Have a safe weekend, and I'll see you next week with a new update.